Welcome to the GoldTime Tracker. I'm Dennis, and today we're diving into one of the most important and eye-opening updates in the global gold and silver markets. What I'm about to share with you is not just routine market news. It's a deep strategic breakdown of the forces currently shaping precious metals. So stick with me from start to finish, because by the end of this video, you'll understand exactly what's happening behind the scenes and why investors worldwide are preparing for a major shift. This might be one of the most crucial analyses you'll hear this month. Right now, the global gold market has officially entered a high volatility tightening phase, a stage where multiple macroeconomic forces collide and reshape the direction of precious metals. Unlike earlier periods where gold's movement depended on a single dominating factor, such as inflation or interest rates, today's environment is driven by a combination of geopolitical tensions, supply chain stress, central bank decisions, and shifting global trade dynamics. If you look at gold as a single-factor asset, you're missing half the picture. Modern gold forecasting requires a multi-layered understanding, and that's exactly what we'll uncover in this complete six-part breakdown. One of the most striking trends unfolding right now is the clear contrast between central bank behavior and retail investor behavior. Central banks around the world are purchasing gold at a record pace, the fastest accumulation cycle in years, while retail investors remain cautious, waiting for corrections or short-term dips. This divergence isn't random. In fact, historically, when major institutions are quietly stacking gold in large volumes, the long-term bullish direction is already being shaped. Institutions don't buy gold for speculation. They buy to secure stability before deep structural changes unfold in the global economy. Another major force influencing gold is the steady weakening of the US dollar index. Gold and the dollar have an inverse relationship. When the dollar loses strength, gold naturally rises. Currently, the dollar is under pressure due to slower economic growth, policy uncertainties, rising debt levels, and global trade realignments. These pressures weaken the dollar's dominance and create a supportive environment for gold to move upward. It's important to understand that gold isn't just reacting to market fear, it's responding to structural weaknesses forming globally. While gold takes the spotlight as a safe haven asset, silver is playing an equally important but different role. Silver is unique because it operates as both a precious metal and an industrial metal. This dual identity makes silver highly sensitive to growth in industries like solar energy, electric vehicles, electronics manufacturing, and renewable technologies. As the world continues to shift toward clean energy and digital infrastructure, silver demand is expected to grow far beyond traditional projections. This positions silver for a long-term surge, especially as industrial expansion meets tightening supply. When you combine all these elements, rising central bank accumulation, weakening dollar strength, industrial demand, and geopolitical stress, a single narrative emerges. Both gold and silver are entering a strategic accumulation phase. Smart money, institutional buyers, and long-term investors are building positions quietly. Historically, these early accumulation phases are the foundation of major price expansions. Retail investors, unaware of the early signals, usually react only when the trend becomes obvious. And by then, the real opportunity is already gone. Around the world, geopolitical pressure has become one of the most powerful engines driving gold and silver demand. Unlike economic cycles that move gradually, geopolitical shocks happen suddenly, and they reshape markets instantly. Right now, multiple regions are facing rising tension, trade disruptions, and political uncertainty, and each one of these developments is fueling a stronger push toward safe haven assets. The global investment community understands that in times of geopolitical instability, precious metals provide certainty when nothing else does. This is why gold demand has surged quietly but steadily across strategic regions, from Asia to the Middle East. At the core of this geopolitical shift is the ongoing conflict between major world powers. The global environment is no longer driven by simple trade disputes. Instead, it has transitioned into a much deeper power struggle involving energy supply, territorial control, global currency competition, and technological dominance. Each flashpoint, whether it's in Eastern Europe, the Middle East, or the South China Sea, creates a shockwave across financial markets. Investors understand that geopolitical events are unpredictable, and unpredictability always translates into higher demand for gold. When uncertainty becomes the new normal, gold becomes the new anchor. The global supply chain plays a crucial role in this picture. Several critical mining regions, particularly those producing gold, silver, platinum, and other essential metals, have faced disruptions due to political unrest, resource nationalization, environmental policies, or labor strikes. Controlled supply, rising extraction costs, and unstable mining conditions have created a supply-tight environment, especially for silver. This mismatch between rising demand and constrained supply is one of the strongest underlying forces supporting long-term price growth in precious metals. While investors tend to focus on economic news, the truth is that supply chain stability is a hidden driver that influences metal prices far more than most people realize. Another major shift is the emergence of economic blocs moving away from the US dollar in global trade. Several countries are actively exploring alternatives, whether through bilateral trade agreements, digital currencies, or gold-backed settlement models. This gradual diversification away from the dollar weakens the currency's global dominance over time, and whenever the dollar loses ground, gold gains strength. Many nations are increasing their gold reserves not just as a safe haven asset, but as a long-term strategy for financial independence. This silent accumulation by governments points toward a future where gold-backed reserves may play a more influential role in international trade. The energy sector is also deeply connected to the gold and silver markets. Rising oil prices, supply constraints, and geopolitical control over energy routes create inflationary pressure on global economies. Whenever energy inflation accelerates, production costs rise, transportation becomes more expensive, and currency values weaken, all of which create a fertile environment for gold and silver to rise. Investors see precious metals as a defense mechanism against the staggering effects of energy-driven inflation, especially during times when traditional markets struggle to adjust. Global defense spending is another key factor. Nations facing geopolitical threats often increase military budgets, accelerating demand for industrial metals, advanced manufacturing materials, and strategic resources. Silver, with its unique conductive and reflective properties, plays a critical role in defense technologies, aerospace engineering, and high-performance electronics. As countries expand defense capabilities, we naturally see increased demand for metals that support this infrastructure. This indirect yet powerful demand adds to silver's long-term bullish outlook. What makes the current environment unprecedented is the combination of global fragmentation, currency diversification, escalating conflict risks, and shifts in international alliances. These overlapping factors create a world where stability is shrinking, and in every era of instability, gold becomes a universal safe haven asset. Investors are now positioning themselves for a multi-year cycle defined by uncertainty, inflationary pressure, and geopolitical tension. As we move deeper into the macroeconomic landscape shaping gold and silver, one of the most critical areas to understand is how key economic indicators and global monetary decisions influence the trajectory of precious metals. Gold and silver are not isolated assets. They are deeply connected to shifts in inflation, interest rates, currency strength, and central bank policies. When these indicators shift, they create ripple effects across global markets, and right now, multiple indicators are aligning in a way that strongly supports the long-term growth of precious metals. The first and most influential factor is inflation. Although many governments report that inflation numbers are cooling down, the underlying cost of essential goods, manufacturing input, energy, and transportation continues to trend upward. This form of inflation, known as structural inflation, is much more difficult to reverse. It doesn't respond quickly to interest rate hikes, and it cannot be controlled simply through monetary tightening. As the cost of living quietly rises, consumers lose purchasing power, currencies weaken, and investors move toward safe stores of value. Gold thrives in such environments because it represents stability when fiat currencies face long-term erosion. Central banks have been attempting to manage inflation through aggressive interest rate adjustments, But the global economy is entering a delicate stage. Raising rates too much weakens growth, but lowering rates too early risks reigniting inflation. This balancing act has created a landscape of economic uncertainty that historically favors gold. When interest rates approach their peak or begin to plateau, gold often enters a strong upward trend. This is because the opportunity cost of holding gold decreases. Investors no longer lose significant value by holding a non-yielding asset, making gold more attractive as a long-term hedge. Another important indicator is the yield curve, a tool that reflects the relationship between short-term and long-term government bonds. At the moment, several major economies, including the US, are experiencing a prolonged inverted yield curve, a rare and highly reliable signal of potential recession. In every recessionary cycle of the last century, gold has demonstrated strong performance as investors flee from riskier assets. The current inversion indicates that markets are pricing in economic slowdown, corporate earnings pressure, and weaker equity performance, all of which strengthen the demand for safe haven assets like gold and silver. Currency fluctuations also play a major role. The US dollar index has been volatile, and whenever volatility increases, gold naturally benefits. A weaker dollar makes gold cheaper for foreign buyers, increasing global demand. Meanwhile, silver's price movements are closely tied to industrial demand and the economic health of manufacturing sectors. With global manufacturing expected to fluctuate due to energy prices, supply chain adjustments, and geopolitical tensions, silver is positioned to benefit from both safe haven buying and industrial consumption growth. Monetary policy from central banks is further shaping the future of precious metals. Institutions like the Federal Reserve, the European Central Bank, and the Bank of England are signaling caution as they assess inflation forecasts and economic risks. Even modest adjustments in policy outlook can trigger large movements in gold. Markets respond not only to what central banks do, but to what they might do. And right now, policymakers are increasingly hinting at prolonged caution, slower tightening, and the possibility of future rate reductions if economic conditions deteriorate. These signals create a supportive environment for gold's next phase. Another overlooked indicator is global debt levels, which have reached historic highs. As governments increase borrowing to stabilize their economies, the long-term consequence is weaker currency strength and higher inflation risk. Gold often rises during periods of high debt because it provides a counterbalance to the long-term instability created by excessive borrowing. Investors understand that currencies backed by high debt become vulnerable, while gold retains its intrinsic value regardless of financial cycles. The combined effect of inflation, interest rate trends, currency weakness, economic slowdown risk, and rising global debt forms a powerful foundation for long-term strength in gold and silver. These indicators don't just point to short-term volatility, they point toward a structural shift, one that could shape precious metal markets for years to come. To understand where gold and silver may be headed, it's not enough to analyze supply and demand dynamics or macroeconomic indicators. The real engine behind every major rally and every major collapse is market psychology. Human emotion, herd behavior, fear, and euphoria have shaped precious metal cycles for centuries. And right now, those psychological forces are building again, slowly but unmistakably. Investor behavior in gold and silver follows a predictable pattern. First comes accumulation, when smart money, institutional investors, sovereign funds, and central banks quietly increase their positions while prices are still stable. This phase often goes unnoticed by the public. Ironically, this is also the period when retail investors lose interest, believing the market is boring. But this is exactly when the foundation of future rallies is laid. Over the last 2 years, central banks have been aggressively accumulating gold at rates not seen since the 1960s. These are not emotional investors. They are strategic actors preparing for long-term shifts in global finance. The next stage is awareness, when early price movements begin attracting attention. Analysts start writing bullish reports, financial news outlets cover rising precious metal demand, and investors begin taking positions. We are currently in this phase. Gold's breakout to new highs and silver's surge have signaled to professional investors that something structural is taking place. But still, the general public remains cautious, caught between fear of missing out and fear of getting burned again. This tension creates volatility, but also provides fuel for the next phase of the cycle. Then comes momentum, the stage where price action begins feeding on itself. Investors who stayed on the sidelines begin entering the market. At first, they buy cautiously. Then the buying accelerates. As momentum strengthens, the emotional pendulum swings from fear toward excitement. This is when the majority of gains in precious metal bull markets typically occur. History shows that once gold enters its momentum phase, rallies can last for months or even years, as investors chase performance and reallocate away from weakening assets like bonds and equities. But momentum also brings risk. When retail investors become dominant, herd behavior intensifies. People stop buying because they understand the fundamentals. They buy because the price is rising. This creates a dangerous feedback loop. Every major silver crash, 1980, 2011, 2021, occurred when sentiment became euphoric and speculative leverage skyrocketed. Precious metals don't just rise on fundamentals, they rise on narratives. And narratives can change instantly. This brings us to one of the most powerful forces in financial markets: fear of missing out, FOMO. FOMO is what pushes investors to enter at the worst possible time, after prices have already risen dramatically. FOMO rarely appears in the early stages. It arrives near the peak, when headlines declare a new era for metals, social media influencers predict outrageous price targets, and retail buyers rush in expecting easy profits. This is also when institutional investors often begin taking profits, using the liquidity created by retail enthusiasm to exit their positions quietly. On the other side of FOMO is fear itself, specifically fear-driven selling. Silver and gold corrections are often violent because the same emotional intensity that drives investors to buy also drives them to panic. When prices drop 10 to 15%, inexperienced investors often capitulate, believing the rally is over. But this is frequently when long-term investors buy the dip, strengthening their positions at discounted prices. Understanding this psychological rhythm, accumulation, awareness, momentum, euphoria, correction, is essential for navigating precious metal markets safely. Another key behavioral pattern involves confirmation bias. Investors naturally seek information that validates their existing beliefs. Bullish investors look for evidence of deficits, geopolitical risk, and currency weakness. Bearish investors search for reasons why gold should correct. This selective perception can distort decision-making. The most successful investors remain emotionally neutral, responding to data rather than emotion. Finally, market psychology today is amplified by technology. Social media accelerates sentiment cycles at a speed we've never seen before. A rumor, chart, or viral post can influence millions of investors instantly. This accelerates both rallies and crashes. It also increases volatility, and in a market as small as silver, volatility can become extreme. As we look ahead, it's clear that gold and silver no longer move solely on economic data. In today's world, geopolitical risk, technological disruption, energy transitions, and global power shifts have become just as important as inflation or interest rates. These forces shape the environment in which precious metals operate, and they can ignite massive rallies or violent collapses with little warning. So let's break down the key catalysts and shock events that could dramatically influence gold and silver in the months and years ahead. First, consider global geopolitics, which is more unstable today than at any point since the Cold War. Conflicts in Eastern Europe, tensions in the South China Sea, Middle East volatility, cyber warfare, and growing friction between major powers have created a world where certainty is rare and risk is constant. Precious metals thrive in environments like these because they represent safety when traditional systems look fragile. A major geopolitical flare-up, a naval conflict, an unexpected military escalation, or sanctions targeting key global economies could instantly push gold and silver into another leg higher as investors seek protection. At the same time, a rapid de-escalation or peace agreement could cool demand temporarily, highlighting how sensitive metals are to political outcomes. Next, we must examine central bank behavior, which is becoming increasingly aggressive. Central banks have been buying gold at record-breaking levels for 4 consecutive years. Nations are diversifying away from the US dollar and increasing their reserve allocations to precious metals. This structural shift isn't based on speculation, it's based on concerns about global debt, currency stability, and long-term inflation. If this trend accelerates, gold could see demand unlike anything in recent history. On the other hand, if inflation collapses faster than expected, or central banks decide to offload reserves, metals could face downward pressure. For silver, central bank impact is smaller, but gold's movement often sets the tone for the entire precious metals complex. Then we have currency instability, especially concerning the US dollar. Historically, when the dollar weakens, metals surge as investors seek alternatives. With US debt at all-time highs and interest rate cuts now part of the policy landscape, the dollar could enter a prolonged period of vulnerability. A major drop in the dollar's international purchasing power or a loss of foreign confidence could unleash a massive wave of safe haven demand. On the flip side, a sudden dollar, strengthening or unexpected rate hikes could cool metals sharply, even temporarily reversing upward momentum. But some of the most explosive catalysts are coming from technology and energy transitions, especially the global shift to electrification. Silver plays a critical role here. The expansion of solar energy, EV manufacturing, and high-performance electronics continues to surpass every projection made over the last decade. If countries push harder toward carbon neutrality, or if new legislation mandates rapid clean energy build-outs, silver demand could surge beyond anything the mining industry can supply. This is one of the few catalysts that can create not just higher prices, but full-blown shortages. But a slowdown in renewable energy adoption or a global recession could weaken this demand sharply. We also need to look at mining supply risks. Many major silver-producing regions are facing labor strikes, water shortages, stricter environmental regulations, or political instability. Any disruption in Mexico, Peru, or China, the top 3 producers, could send silver prices soaring. Gold faces similar risks. But conversely, if silver hits extremely high prices and stays elevated, mining companies will eventually respond by increasing output, which could ease long-term pressure. And then there are black swan events, unpredictable shocks capable of reshaping markets in a matter of hours. A major financial institution collapse, a surprise sovereign default, a cyber attack on global banking networks, a new pandemic wave, or a sudden commodities embargo could send investors flooding into metals. These events are rare, but history shows they have disproportionate impact on precious metals. One more catalyst deserves special attention. Investor psychology-driven demand spikes like the ones seen in 1980, 2011, and 2021. If retail investors swarm into the silver market again, not out of hype, but out of genuine fear of inflation or currency debasement, the price could move faster than miners or regulators can react. But the same emotional intensity that fuels a rally can also cause a collapse when sentiment flips. As we reach the final part of this deep dive, it's time to bring everything together: the history, the fundamentals, the risks, and the structural forces shaping the 2025 silver and gold markets. Because after examining nearly 5 decades of market behavior, one truth becomes crystal clear. This is the first silver rally in modern history, driven not by hype, manipulation, or temporary speculation, but by a genuine mismatch between global supply and industrial demand. That is what makes the current situation so different, so powerful, and also so dangerous for anyone who misunderstands the volatility that comes with real structural change. The silver market of 2025 is not the silver market of 1980, 2011, or 2021. It isn't being inflated by 3 wealthy brothers attempting to buy every ounce they can find. It isn't being inflated by retail traders chasing a dream on Reddit. It isn't being inflated by fear alone. This time, the engine behind the rally is the physical deficit, millions of ounces disappearing from vaults, industrial buyers competing with investors, and a global economy shifting toward technologies that depend on silver as an irreplaceable input. The laws of supply and demand don't care about narratives, they don't care about opinions, and they definitely don't care about investor emotions. They operate mathematically, whether markets are ready for them or not. But understanding this does not eliminate risk. In fact, the higher the price climbs, the more the risk rises with it. Silver at $61, $70, or even $80 in the future may reflect a real shortage, but that doesn't mean the path upward will be smooth. Corrections are inevitable. Sharp declines are normal. A 15 to 25% pullback isn't a warning sign of collapse. It's simply how commodity markets breathe. Investors who don't understand this mistake volatility for danger when it can just as easily be opportunity. At the same time, investors who become overly confident ignore the reminders history has carved into the markets. Leverage destroys, hype blinds, and timing is everything. So, where does that leave you? Whether you own silver, gold, or are simply watching from the sidelines, the most important thing you can do now is think in probabilities, not predictions. The data suggests silver's long-term trajectory remains upward due to industrial use, shrinking inventories, and structural deficits. But short-term swings, even dramatic ones, are not only possible, they are guaranteed. If your strategy cannot emotionally or financially survive those swings, then your position is too large. If you're entering the market out of fear of missing out, you are already starting from a losing mindset. And if you're making decisions based purely on headlines, hype, or online noise, you are ignoring the deeper forces actually moving the market. The best approach, especially during extreme volatility, is to remain disciplined. Long-term investors who believe in the supply deficit often choose dollar-cost averaging, reducing the emotional intensity of each price move. Short-term traders rely on technical confirmations, stop losses, and predefined exit strategies. And those waiting for better entry points may benefit from observing corrections before committing. No strategy is perfect, but the worst strategy is having no plan at all. As we conclude this analysis, remember this. The silver market today is incredibly powerful, but power cuts both ways. The same forces driving prices higher can create violent reversals. The same supply shortages that strengthen the long-term case can be overshadowed temporarily by macroeconomic shocks. And the same investor enthusiasm that fuels rallies can turn into panic just as quickly. You can be absolutely correct about the long-term fundamentals and still lose money if your timing, risk management, or emotional control fails. So before you act, slow down. Think clearly. Understand what you are buying, why you are buying it, and what level of volatility you can personally handle. The wolf may be real this time, but even a real wolf can bite anyone who approaches without caution. This video is for educational and informational purposes only and should not be considered financial, investment, or trading advice. I am not a financial advisor. All investing involves risk, including the potential loss of principal. Viewers should conduct their own research or consult with a licensed financial professional before making any investment decisions. Past performance does not guarantee future results.